Breakdown of blocdirect fact sheets. Keep in mind that the values in this example are only projections and may change depending on the case. 1. Multiplex's full address. 2. List price and hypothetical price. The list price equals the price set by the seller. The hypothetical price equals the price determined by blocdirect. The projection is based on the hypothetical price, established according to the statistics produced by Quebec City's Real Estate Board, the Chambre Immobilière de Québec. Multiplexes are usually sold at 95% of the list price. Consequently, on most of blocdirect's fact sheets, the hypothetical price corresponds to 95% of the list price. However, blocdirect must indicate the asking price, 100%, on properties for which it has a brokerage contract. 3. Municipal evaluation. In addition to an appraisal of the land and building, you will find the lot number, the year built. Note: investors, appraisers, the CMHC, etc. rarely consider the municipal appraisal. This appraisal is a triennial, 3-year roll that includes comparables, transactions that can go back 18 months prior to the first day of the appraisal. The appraisal could therefore be 4.5 years old. 4. Total units and rooms. The example indicates 8 2.5 units, 2 4.5 units. This totals 8 times 2.5 equals 20 rooms, and 2 times 4.5 equals 9 rooms. 20 plus 9 equals 29 rooms. 5. Unit distribution and characteristics. Unit distribution. Number of units and their size. Characteristics. Average rent, according to size. Number of units that include heating, electricity, hot water. Number of units leased semi-furnished, stove and refrigerator, and fully furnished. 6. Heating. Type of system and energy used. Note: example, hot water or forced air heating, powered by fuel oil or natural gas, electrical heating, baseboard heaters, etc. 7. Debt service, financing. Our projections are usually based on a loan that will be insured by the CMHC at 85% of the hypothetical price. The balance is the total amount of the mortgage needed to purchase the multiplex. The mortgage is generally paid back over 30 years, 360 payments. The interest rate is based on recent negotiations with lenders for mortgages insured by the CMHC. This rate may vary. Monthly payments are the portions of the loan paid back each month. 8. Income. Total income generated by the multiplex annually. Other income. Additional income. Renting garage space, warehouse, laundromat. Vacancies and bad debt. As a preventative measure, even if this does not happen, the amount is based on the rate set by the CMHC, on which we add a plus or less 2% reserve. Note that the CHMC, appraisers, and lenders do the same. Actual gross income equals total income plus other income, minus vacancies and bad debt. Note: vacancy rate. In Quebec, most leases end on June 30th. The Rental Commission, Régie du Logement, allows owners to send a lease renewal notice and put up the rent 3 to 6 months before the end of the lease. The tenant has 30 days to answer. If the tenant does not respond, the lease is automatically renewed at the higher rate. Most landlords send this notice in January. About 20 to 30% of units become vacant each year for a number of reasons. For example, in a 10-unit building, 2 or 3 units will be vacated each year. Given that the owner will be aware of this situation by February, he or she will have about 5 months to find new tenants. 9. Operating expenses. Municipal taxes. School taxes. Insurance. Heating, electricity, hot water provided for the tenants. Common energy, cost of heating and electricity for the common areas. Maintenance and renovations, $400 per unit. Janitorial services. Managers pay janitors $15 to $20 per unit times 12 months, an average of $18. Snow removal, agreement with a contractor. Advertising, to lease vacant units. Property management. Reserve for furniture, furnished and semi-furnished units. Trash container rented from a company that offers garbage pickup. Other, pool, maintenance and lifeguard, elevator, maintenance, etc. Notes in general. Maintenance and renovation. For example, in a 10-unit building, 2 departures are planned for July 1st. To repaint a 4.5-room unit, it will cost $250 for labor times 2 coats of paint plus $100 for the paint, totaling $600. If the landlord does the work himself, it will only cost $100, the cost of the paint. $600 may be too expensive for some people. It's all relative. Janitor. The janitor mows the lawn, clears the snow from the walkways, cleans the common areas once a week, collects the rent, etc. Property management. When a building has 10 units or less, it falls into the recreational category, and the management fees are not accounted for. When a building has 11 to 20 units, we add 3% of the actual gross income to the expenses. For buildings with over 21 units, we add 5%. In the latter 2 cases, companies act as the owner, and their management fees make up 5% of the gross income collected, plus taxes. 10. Net income before financing and cash flow. Net income before financing equals gross income minus vacancies and bad debt minus operating expenses. Debt service equals monthly mortgage payment times 12 months. Cash flow equals what remains once everything is paid. 11. Down payment. Down payment equals price paid plus transfer tax or welcome tax plus notary fees plus other expenses minus mortgage, including CMHC premium, minus first month of rent. Other expenses include appraiser's fee, financing fees, negotiable but can total 0.25% of the mortgage, soil test, normally required by the lender to ensure that the soil is not contaminated, for example. CMHC premium, paid by the lender, 4.75% of the mortgage plus $150 per unit. 9% tax, to pay on the insurance premium. Note, first month of rent. The first month of rent must be considered because the rent is payable in advance. For example, if the new owner takes possession of the building on the first of the month, the rent payments are his or hers and can be put toward the down payment. It is only the next month that these amounts will be used to pay the mortgage. 12. Yield on invested capital. Before capitalization equals cash flow divided by down payment. After capitalization equals cash flow plus average capitalization over 5 years, mortgage paid after 5 years, divided by down payment. After capitalization and appreciation, increase in value, equals cash flow plus average capitalization over 5 years plus appreciation, increase in value, divided by down payment. Note, IV. IV, or increase in value, is the value the property takes on over the next several years. According to Statistics Canada, the Canadian Consumer Price Index was 2.6% from 1986 to 2006. Building costs rose 5.8% per year from 1990 to 2009. Therefore, a 3% projection is conservative. Ratios. Ratios allow you to compare one multiplex to another based on cost while taking into account the price paid. Hypothetical. Price per unit equals price paid divided by number of units. Price per room equals price paid divided by number of rooms. Example, compare 10 4.5 room units and 10 1.5 room units. Price of a standard 4.5 room unit on the market equals price per room, see second item, times 4.5. GRM, gross income multiplier, equals price paid divided by total adjusted income, see note. NRM, net rent multiplier, equals price sold divided by net income before financing. CAP, overall capitalization rate, equals net income before financing divided by price paid. DCR, debt coverage ratio, equals net income before financing divided by debt service. Note, total adjusted income, GRM. The total adjusted income is calculated by subtracting the elements with an asterisk in the expenses column from the income. This allows you to compare the building's income with the income of a building that does not offer the tenants any energy and furnishing service or any common